Did you know that you can invest in rental properties with little to no money down? It sounds almost too good to be true, but it's a strategy that savvy real estate investors have been using for years. Whether you're just starting out your investment journey or you're looking to expand your portfolio, understanding how to leverage other people's money is a game changer. If you're curious about how this works and want to start building wealth through real estate, stick around because I'm going to go into a deep dive about these strategies today. Hi, I'm Bud Evans. I'm a retired 35-year military veteran, 13-year former police officer, and former coach for Tarek El Moussa. And in today's video, we're going to explore how you can start investing in rental properties without needing a large down payment. The idea that you need tens of thousands of dollars sitting in your bank account to start investing in real estate is a common misconception, but it's just not true. These beliefs keep a lot of inspiring investors on the sidelines thinking that real estate investing is only for the wealthy or for those who have been saving for years. In reality, there are a lot of strategies that allow you to get started with very little upfront capital. By the end of this video, you're going to know exactly how to get started with a minimal down payment or even no money down. But before we jump into the specifics, let's set the stage. Why is real estate such an effective way to build wealth? Well, for centuries, real estate's been one of the most powerful wealth building tools. It offers multiple streams of income, from rental cash flow to property appreciation, when it comes with significant tax advantages, and your tenants pay your mortgage for you, so you get equity. When done right, real estate investing allows you to create passive income, build that equity, and achieve long-term financial freedom. Today, we'll explore several strategies for acquiring rental properties with little or no money down, including seller financing, partnerships, and government programs. I'm also going to cover some other creative financing options like lease options, hard money loans, and house hacking. By the end of this video, you're going to be ready to take action and take your first steps towards building a real estate portfolio without needing a huge pile of cash. One of the biggest misconceptions about real estate investing is that you need a significant amount of money saved up for a down payment. This belief is so widespread that it discourages a lot of investors from even trying. They assume that only people with substantial savings or high incomes can invest in rental properties. But this just isn't true. The traditional 20% down is not a requirement for all real estate. Yes, conventional loans often require that, but there are so many other options that require much less or sometimes nothing at all. What if I told you that there are investors out there who have acquired multiple properties without even putting anything down, or maybe a few $1,000s or even less in some cases? It's possible, and I'm going to show you how. Today, we're going to dispel that myth that you need a lot of money to start investing in real estate. We'll cover real-life examples of investors who started with almost nothing and built thriving real estate empires. If they can do it, so can you. The key is to understand and utilize creative financing strategies that allow you to leverage other people's money to grow your portfolio. So let's start with one of the most powerful strategies, seller financing. In a seller financing deal, the seller of the property acts as the bank. Instead of going through a traditional lender, the buyer and seller agree to terms, and the buyer makes payments directly to the seller. This is a win-win situation. The seller gets to sell their property and earn interest on the loan, while the buyer can often negotiate more favorable terms, including little to no down payment. Seller financing is particularly common in situations where the seller owns the property outright and doesn't need to pay off the mortgage. This allows the seller to be more flexible in structuring the deal. So instead of receiving a large sum from the sale, the seller receives regular monthly payments, just like a bank would if they were issuing a mortgage. Here's an example. Let's say you're interested in purchasing a $200,000 rental property. The seller agrees to finance the deal, and you negotiate a payment plan where you pay $1,500 a month over the next 10 years, with a balloon payment at the end. The seller might ask for a 5% down payment or even less, which could be $10,000 in this case. Compare that to the $40,000 you would need for a 20% down payment with a traditional mortgage. One of the biggest advantages of seller financing is the ability to negotiate a lower down payment or no down payment at all. Sellers who are motivated to sell quickly or want to avoid complexities of dealing with a bank might be open to flexible terms. What are flexible terms? Well, unlike traditional lenders, sellers may be more willing to negotiate the interest rate, the loan term, and the repayment schedule. This flexibility can make it easier to acquire the property even though you don't meet the stringent requirements of a traditional mortgage. Next, without the need to wait for mortgage approval, seller finance deals can often close much faster. This can be especially beneficial in competitive markets where other buyers might wait weeks for a loan approval. So let's give you an example. Talk about Sarah. She was a young investor who wanted to purchase her first rental property but didn't have much saved up. She finds a motivated seller who owns a 4-unit building that's free and clear and willing to offer seller financing. The seller asks for a $5,000 down payment and agrees to refinance the remaining $195,000 at 5% interest over 10 years. Sarah's monthly payment is about $1,500 and she collects $3,000 in rent from the property. After covering her mortgage, taxes, and insurance, she's left with $500 in positive cash flow each month. She's living in one of the apartments. She's now a landlord with minimal upfront investment. She's living in a house and making money to do so. This strategy allowed Sarah to enter the real estate market without needing a large down payment. After a few years of making payments, Sarah had enough equity in the property and she used that to refinance and purchase her next investment property. Another powerful way to invest in rental properties with little to no money down is by forming a partnership. In typical real estate partnerships, one partner provides the capital while the other handles the day-to-day management of the property. This allows individuals who lack the necessary funds to invest in real estate leverage the resources of a partner. There are several types of partnerships that can be used in real estate investing. A capital partner can partner with a sweat equity partner. In this arrangement, one partner provides the down payment and financing, that's the capital partner, while the other partner contributes their time, expertise, and effort in managing the property and maybe does the rehab. That's the sweat equity partner. Profits are split based on the contributions of each person. In a joint venture, two or more investors pool their resources to purchase and manage a property together. Each partner contributes capital, expertise, or both, and they share the profits accordingly. The key to a joint venture is that everyone needs to participate. Next is syndications. Real estate syndications involve multiple investors pooling their money to buy larger properties like apartment buildings or commercial properties or storage units, et cetera, et cetera. The sponsor or syndicator manages the investment while the investors provide the capital. Syndications can be a great way to invest in a large-scale property without needing significant capital upfront out of pocket. And partnerships offer several advantages to investors who may not have enough capital to invest on their own. By partnering with someone who has the financial resources available, you can invest in properties that you might not be able to afford on your own. Investing with a partner also allows you to spread out the risk. If the property doesn't perform as expected, you're not solely on the hook for the financial loss. You can have complementary skills. In a partnership, each person can bring different strengths to the table. For example, one partner might have experience in property management, while the other has a background in finance or construction. So let's talk about John and Lisa. These are two friends who both wanted to invest in real estate but faced different challenges. John has $50,000 in savings, but he didn't have time to manage a rental property. Lisa, on the other hand, has experience managing rental properties, but she lacked the capital to make the down payment. They decided to form a partnership where John provided the down payment and Lisa managed the day-to-day operations of the property. They purchased a duplex for $200,000, and the rental income covered the mortgage and generated a small monthly profit. Over the next few years, the property appreciated in value, and John and Lisa decided to refinance and pull out some of the equity to purchase another property. Together, they're able to grow their portfolio without either of them needing to come up with all the money or manage everything alone. Now, finding the right partner is the key to a successful partnership. Here are a few tips for finding potential partners. First, network with other investors. Attend real estate meetups, join online forums, become a member of your local RIA, that's a real estate investment association. And these are great places to meet potential partners who share your goals. Don't overlook existing connections. Friends, family, or colleagues might be interested in investing in real estate, but don't have the time or the partnering with someone you already know and trust can make the process a lot smoother. This is like a marriage, guys, so be clear about your expectations. Before entering into a partnership, it's essential to have a clear agreement about each person's responsibilities, profit sharing, and exit strategies. This is going to help you avoid conflicts and ensure that everyone is on the same page for the future. There are several government programs that are designed to help first-time homebuyers and investors get into the market with minimal upfront costs. The programs offer low down payment options, making them an excellent choice for investors who want to get started with little money down. First, let's talk about FHA loans. The Federal Housing Administration, or FHA, offers loans that require as little as 3.5% down. While FHA loans are typically used by first-time homebuyers, they can also be used to purchase multifamily properties up to 4 units, provided that the buyer lives in one of the units. This strategy, known as house hacking, allows you to live in one unit while renting out the others to cover the mortgage. And in all honesty, if I were to start over today and be a lot younger, that's exactly what I would do. So imagine you buy your fourplex for $400,000 using an FHA loan. With a 3.5% down payment, you only need $14,000 up front. You live in one unit, rent out the other 3. If the combined rent from the 3 units covers your mortgage, you're essentially living rent-free while building equity in the property. Vets, I'm talking to you. Let's talk about VA loans. Veterans Affairs loans, or VA loans, are available to eligible veterans and active duty military members and allow for 0% down payments. Like FHA loans, VA loans can be used to purchase multifamily properties with up to 4 units, provided the buyer lives in one of the units. Are you a veteran or first responder and you're ready to start your journey into financial freedom through real estate investing? Don't wait. Take action now and unlock your potential for success in real estate. Let's turn your dreams of financial freedom into reality. Head to budevans.com and schedule your strategy session now. Guys, let's talk about one of my former students. Not going to name him, but he's a veteran. He used his VA loan to purchase a fourplex for $350,000 with no money down. He was renting an apartment, $1,200 a month. He lived in one unit, rented out the others, generating enough rental income to cover his mortgage and made $700 a month. Over time, he built equity with the property, enjoyed the benefits of home ownership without having to pay rent or a mortgage. That's a net swing, guys, of $1,900 per month. Let's go into USDA loans. The United States Department of Agriculture offers loans requiring no money down for properties in designated rural areas. This does not mean that it's really rural. You're not buying a farm here. there are areas that are pretty densely populated. While USDA loans are typically used for primary residences, they can be an excellent option for investors who want to purchase property in rural areas with strong rental demand. Like near military bases would be a great example. The best is you can use these over and over and over again. In addition to seller financing, partnerships, and government programs, there are several other creative financing strategies that can help you invest in rental properties with little or no money down. So let's talk about a few more options. A lease option allows you to lease a property with the option to purchase at a later date. This strategy gives you control of the property and allows you to generate rental income without needing a large down payment. So let's say Emily wanted to invest in a rental property but didn't have enough money for a down payment. So she entered into a lease option agreement with the seller, agreeing to lease the property for 2 years with the option to purchase it at the end of the lease. During the lease period, Emily rented out the property and used the rental income to save for the down payment. After 2 years, she exercised her option to purchase the property using the equity she built through the lease payments as part of her down payment. Let's talk about hard money. Hard money loans are short-term loans that are provided by private lenders, typically used to finance fix and flip properties. These loans are based on the value of the property rather than the borrower's credit. This makes them an attractive option for investors who want to purchase and renovate a property quickly. And this is what I use primarily for my BRRRR properties. So let's say you find a distressed property for $150,000 that you believe you can flip for $250,000. So you secure a hard money loan for the purchase and renovation costs with the understanding that the loan will be repaid within 12 months. After completing the renovations, you sell the property for a profit and repay the hard money loan, keeping the difference as profit. That's very simplistic, but that's how it works. We've kind of touched on this already, but let's hit it again because it deserves it. House hacking is a strategy where you purchase a multifamily property, live in one unit, and rent out the others. You can do this room by room as well. The rental income from the other units covers your mortgage, allowing you to live rent-free while you're building equity in the property. So let's say you buy a triplex using an FHA loan with 3.5% down. You live in one unit and you rent out the other two. The rental income from the other units cover your mortgage, so you're essentially living rent-free while building equity in the property. After a few years, you refinance the property, pull out some equity, then use it to purchase another multifamily property and rinse, cycle, and repeat. While investing in rental properties with little or no money down, this can be incredibly rewarding. It's important to understand the risks that are involved. These strategies require careful planning, negotiation, and a thorough understanding of the market. For example, while seller financing can be a great way to acquire a property without a traditional mortgage, it comes with higher interest rates and shorter loan terms. This can result in higher monthly payments, which could strain your finances if the property doesn't generate the expected income. Remember when I said partnerships are like a marriage? Okay. Partnerships can be highly rewarding, but they also come with potential challenges. Disagreements over responsibilities, profit sharing, or management decisions can really strain your relationships and jeopardize the success of your investment. It's crucial to have a clear agreement down in place from the start and avoid the conflicts down the line. Make sure you have that exit strategy at the end, mine set for 5 years with a reassessment. FHA and VA loans offer great benefits, but they come with restrictions. For example, you're going to need to live in one of the units for at least a year if you're using FHA loan for multifamily property. Failing to meet these requirements can result in penalties or loan denial. A couple videos back, I talked about due diligence. So to mitigate these risks, it's crucial to conduct thorough due diligence before entering into any deal. This includes your market research. Understand your local real estate market, including rental demand, property values, and economic trends. This will help you make informed decisions about where and when and what to invest in. Do your property analysis. Evaluate the condition of the property, the potential repair costs, and expected rental income. Make sure that your property will generate enough cash flow to cover your expenses and leave room for profit. Always consult a professional. Working with a real estate attorney, tax advisor, and property inspector can help you ensure that all the agreements, especially in partnerships and seller financing deals, are legally sound and financially viable. Investing in rental properties with little to no money down is not only possible, but it can be highly profitable if you do it right. By leveraging creative financing options, forming strategic partnerships, and taking advantage of government programs, you can start building a rental property portfolio without needing a large upfront investment. The long-term benefits of investing in real estate are substantial. As you pay down your mortgage and your property appreciates in value, you build equity that can be used to finance your future investments. Your rental properties can generate positive cash flow, providing a steady stream of income that supplement or even replace your primary income. Real estate investors can take advantages of various tax benefits, including deductions for mortgage interest, property taxes, and depreciation. If you're ready to take the next step in your real estate investing journey, make sure to explore our other videos where we dive deeper into the strategies and provide more tips on how to achieve financial freedom through real estate. And as always, aim high. Thanks for watching. We hope you enjoyed it and learned something new today. If you did, please show us some love and smash that like button. Your support means everything to us and helps us reach more people like you who want to aim high in real estate. Don't forget to hit that subscribe button along with the notification bell icon so that you can stay up to date on all of our future content. If you're hungry for more real estate and finance related videos, we've got you covered. We can't wait to see your success stories in real estate investing. Till next time, aim high. Bud Evans signing off. We'll see you soon.